RJ Baxter here, Fairway Independent Mortgage with your market update. So it's almost October, hard to believe. It's about 7:30 in the morning right now, and it's a little bit chilly. I'm gonna have to get out the long sleeves here pretty soon. Just unbelievable how time flies, and we have had another Fed meeting as time flies. The Fed cut rates by 0.25%, which was widely expected. Now, this didn't have hardly any effect on the mortgage market. Things improved a little bit, but again, as I've talked about in previous market updates, a Fed rate cut does not necessarily lead to lower mortgage rates. It's more about the language in the Fed statement. And in the Fed statement, they express the fact that they think that inflation inflation remains tame in the economy. Now, this is very, very important that they said this, because I wanted to talk this week about how inflation affects mortgage rates. So inflation is the arch enemy of mortgage rates, because mortgage rates are tied to mortgage-backed securities, which is a fixed security instrument, a bond that affects where mortgage rates are. Now, as these bonds ebb and flow in yields, mortgage rates change. Now, if you think about this, a 30-year fixed mortgage rate as an example, this is tied to a 30-year bond, which is a long-term investment. 30 years, that's a long time to hold an investment. So if you think about how inflation would affect an investment like this, if you have a bond that's, let's say, at 2%, for example, and inflation increases to a point where it exceeds 2%, you're going to have an investment that actually has a negative return in relation to inflation. So as inflation increases, it erodes the value of a long-term security instrument like this. Therefore, the yields that are paid on these types of bonds have to increase to offset inflation, and therefore mortgage rates increase. So it's good for mortgage rates that the Fed said that they think inflation will remain tame. In reality, there's an inflation number called Consumer Price Index that came out this week that was at the highest level that we've seen for 11 years. 11 years. Now, it's not a crazy number, but it's just a little bit higher than we've seen for that 11-year high. So this is something important to watch in relation to the economy and in relation to mortgage rates as we head into the fall here. Now, the overarching opinion of a lot of industry experts is that mortgage rates are going to continue to improve. We'll see what happens. Usually in a weaker economy, rates improve. So we'll see if that does play out as we get more and more signs the economy is weakening. But that's just a little bit about what happened with the Fed meeting, the kinds of things that they said. Federal Reserve, not Federal Reserve, but similar type people in other countries like Europe have expressed that they're seeing signs in the economy that things are starting to weaken. So very, very interesting. And we see in places like Europe that rates are actually negative in a lot of places. So who knows if that would happen in the United States, but very interesting to see globally. So anyway, that's a little bit about what's going on with the economy and the Fed meeting that happened this week. Let me know if you have any questions on that. And of course, if you have any questions about home loan related things, give me a call. That's why I'm here. That's what I do. And you guys have a great rest of your day. My name is RJ Baxter, Fairway Independent Mortgage.